Hi, everyone. Thank you so much for joining us today. We are the ASC Finance Committee. I'm Sonia, and then Shannon and Christian are here with me, and we're really happy to welcome Wescom, who will be presenting on investments today. So I'd love to turn it over to Sal, who's the relationship manager at Wescom.
Thank you, Sonia. Good afternoon, everyone. My name is Sal Murguia, relationship manager with Wescom Credit Union. I'm joined by my colleague, David Bochter, in the Partner Development Department, and our two featured speakers as well, Carl Gerstenacker and David DJ Jebzinski. And before we get started, I just want to give you the listening audience or the viewing audience a little context as to why Wescom and our association with UCLA, so then you'll have a little bit better idea of who we are and what we do, and that the information that we're sharing with you is from a trusted resource. So I'm just going to share my screen and I'll just ask the question. Can everyone see my screen at this point? Yeah, thumbs up. DJ, Carl, David, you all see it? Okay, good. Yep. All right, so let me just start my slideshow here. So Wescom Credit Union, better banking for Bruins. Wescom Credit Union was established in 1934. We're one of the largest credit unions in Southern California. We're a non-for-profit financial institution, which means that we offer similar products and services that you would find at a bank. But since we are a non-for-profit, if you do business with Wescom with your daily banking, we'll be able to save you money in the form of lower fees and lower rates. Because by law, any profit that Wescom makes, we have to give a certain percentage back to our members or customers. So that's what makes credit unions unique in the financial world. So we have 24 Southern California branches, and we have a location in the UCLA Ackerman Student Union as well. So about 5 years ago, Wescom and UCLA joined in a partnership where Wescom became the official banking partner of UCLA Athletics, Campus Life and Recreation, and the Alumni Association. So that's why you see Wescom typically on campus. You see a big Wescom presence at the Rose Bowl. You'll see a big presence from Wescom at athletic events and UCLA related events. We are just a big sponsor of Spring Sing this last Friday, which was a pretty fun event to sponsor and attend. But our main goal with our association with UCLA is to build better lives for Bruins and the Bruin community. We want to be a resource for the entire Bruin community that includes students, alumni, faculty, and staff. And I just want to let you all know that we have expanded our partnerships with UCLA Staff Assembly and also with the DASHU Center at UCLA to help support international students as well. So that's not only are we the official banking partners of those that are listed, we're spreading our wings and helping reach out to even further segments of the UCLA population. But not only are we a resource for all those that are a part of the UCLA community, but we also want to create financial healthy habits, and then we want to make banking easy. And through that, making banking easy, we want to let you all know that your banking experience with Wescom would be very similar as you would find at a for-profit bank. And we offer the same bells and whistles and same technology that you would find at a for-profit bank. So with that being said, you can bank with us from anywhere. We offer online and mobile banking, mobile wallet, snap deposit, also Zelle. And then we also have a strong ATM network with over 30,000 fee-free ATMs nationwide. That means when you do a transaction at a credit union affiliated ATM, you won't get charged any surcharge fees. So you'll save money with any sort of out-of-network withdrawals with Wescom, as long as it's with the credit union. A couple of exclusive offers that we have for the UCLA community. We have our UCLA Visa cards, which is our Bruin Edge and Bruin Choice cards. And we also have a 0% tech loan, 0% interest rate tech loan. So if you're looking to upgrade your technology, looking into getting a new tablet, perhaps a new phone, any digital technology that would help support you in your remote learning capabilities, or or if you're on campus and you need to get upgraded on campus with some of your digital support, Wescom has a loan that's there for you that's exclusive to the Bruin community. Going back to our Bruin Visa cards, there's a couple of highlights to what those Visa cards will will support you. And if you choose to use this card, you can get a 0% interest APR for the first 6 months, 50,000 points after $2,500 spent within the first 3 months. You get 1.5 points for every dollar spent at any for any purchases. But I also wanted to point out that you get 5 points for every dollar spent at all these various listed UCLA affiliated locations, especially a lot of the vendors that you see on campus, a lot of the restaurants and UCLA affiliated organizations and restaurants. So, you know, it's a great card. A lot of people are taking advantage of it. And if you're a student, you're looking at establishing your credit, the Bruin Choice card would be a great card for you. But I'm not here to sell Visa cards. We're here to promote financial literacy. And we want to give you resources for helping you out to develop your own personal financial wellness situation. That being said, for UCLA students on campus, we have the UCLA Financial Wellness Program. It's a peer-to-peer organization. So it's students helping students in financial literacy. So make an appointment with the contact information that's listed on the page here. Also, we have your own personal UCLA financial advisor. It's Carl Gerstenacker. He's one of our featured speakers this afternoon. So if you're interested in learning more about your own personal finances, learning about, you know, investments, if you're learning about retirement, any issues that pop up from today's discussion, please, we'd like you to make an appointment with Carl at the contact information listed on the page here. And he'd welcome to have a conversation with you and discuss your personal financial situation. As I mentioned, Wescom is one of the larger credit unions in Southern California. We have 24 Southern California branches located throughout Southern California, open Monday through Friday from 9 a.m. to 6 p.m., Saturday 10 a.m. to 5 p.m. For those of you who are not on campus, we recommend that you go to our website and find the closest branch to you. But if you happen to be on campus, we have our Wescom UCLA campus branch, which is located on the first floor of the Ackerman Student Union, which is open Monday through Friday from 10 a.m. to 5 p.m. Some of the features that we have is an on-site coin machine, a walk-up ATM. Martha Prado is our branch manager, so her contact information is listed there. So please feel free to walk by the branch. It's located right across from Panda Express in the Student Union, and they're a great support system as well if you're looking to get some answers on your personal financial well-being. If you participate and win this afternoon, we'll award one lucky participant with a $20 UCLA store gift card. So as I mentioned, my colleague David Bochter will be joining the rest of the team in monitoring comments and questions that may come through the chat line, or someone raises their hand and we'll call upon you to ask the question. But yes, if you participate, you'll be automatically entered into the $20 gift card raffle, and we'll select that lucky participant at the conclusion of the presentation. You can please contact us at any time at ucla.wescom.org or at our 888-493-7266 number with any questions or comments or inquiries about Wescom and what we do. So I want to just say thank you for your time and consideration. Right now, I want to turn this over to our featured presenters. Our presenters are Carl Gerstenacker. He's a financial advisor for UCLA and for our Culver City location for Wescom, but he's the representative for UCLA, so he's our financial advisor for UCLA. He's a UCLA alumnus, so you know he's one of the proud Bruins that have graduated from UCLA. And then David DJ Jabzinski, he's the director of investment services with Wescom Financial Services. So this is a great presentation. I hope that you will get a lot out of the information that they present to you this evening. So gentlemen, David, DJ, Carl, take it away.
All right, thanks, Sal. Great to be a part of the event tonight. We deeply appreciate it. As I'm looking at how many are on the Zoom call here, I know we have one individual that's on the call that actually was a former UCLA intern for us, and that's Shannon Leo. So we're so excited to be a part of the group tonight, to be presenting. I know Carl and I have been doing this for many years and presenting to the UCLA Bruin community, and so we really enjoy it, and the topic hopefully everyone will also enjoy tonight. So we're going to talk about investing 101, and I know many of you are very comfortable with investing, and some of you it may be new, and so we really want to encourage a lot of dialogue tonight. interaction between all of you. Ask questions. Although we have some set slides that we want to go through, this is your presentation. Questions that you want to talk about. There's so much going on in the world right now as it relates to investing, the economy, and we're going to touch on some of these topics tonight. So let's get right to the slides. We have about 48 slides. I know that seems like a lot. We'll make sure that we'll stop right at 6 o'clock as we go through the material. If there's questions you have, I know David Bachter on our team will be monitoring the chat. So if there's questions that come up, he will stop us and say, hey, the two of you need to talk about this question and address it immediately. So we will absolutely do that. So let's get right to the slides. Here's what we want to talk about tonight. And hopefully this is the first time you're seeing this information. If it's not, and maybe you've seen this presentation before that we've done, hopefully we're going to add a few updates to it. But again, here's what we want to talk about. What's happening today in the markets? There is a lot going on as it relates to inflation and risk, types of investment, how to do a proper asset allocation. We're going to touch on tax, although we're not tax advisors, but we do provide assistance and guidance to all of our clients and members that work with us. And then we're going to talk about retirement accounts. I know that may be the last thing on everyone's mind, but it's never too early to start planning for retirement. And so Carl and I, we're going to be going back and forth as we talk about these slides and making sure that we touch on that, because I think that's very, very important. I'm just going to put this slide up, some disclosures here. Again, we're going to talk about some things, of course, that relate to investments. And as everyone knows, investments are not insured or guaranteed. So we want to make sure to put that disclosure up. And then also, here's Carl's contact information. So this is, some of the things that Carl does as far as representing Culver City as well as UCLA. And it has this contact information here. And I'll put this up one more time at the end of our presentation. So let's get right into the material here. We're going to talk about investments and fundamentals. Some people would say investing is speculating, and some would say, well, they would view investing as actually saving and putting money away in a credit union or even a bank. But really, investing is just having a carefully planned approach to accumulating wealth and managing money through your lifetime. It's not just a point that you arrive at. It's basically the journey along the way. And that's what we're going to talk about, is what should investing look like? It is not speculating, and investing is not opening up a traditional savings account, but basically it's investing in the market, in mutual funds and stocks and bonds. And we're going to talk about these things tonight over the next 45 minutes here. Very important slide that I'm going to put up here, and I thought this would be important to add to the dialogue tonight that we're going to have, and that's to talk about inflation. Now, many of us have read this in history books as it relates to investing, and that is, when has inflation been as high as it is today? And you'd have to go back to the 1970s to look at this. So what you have up on the screen here, and you may have seen and heard this in your economics class, and that is CPI, which is this is basically our inflation number. This is, the number that all of us are looking at when it comes to the market, comes to investing. So something I want everyone to focus on is what is called headline CPI. So you have Consumer Price Index, which is really CPI. And so this highlighted number that says headline CPI, I want everyone to look at that. Now, this is the latest number that did come out. This was in March of 2022, 8.6%. They did release April, and it's not on the slide here, but April was 8.3. So why is that important? Because what they're doing is they're saying, let's take a look at the cost of food and energy, housing. We're going to include all of this together and come up with a number. And through April, it was 8.3. Why that's so critical is look at this 50-year average, the 50-year average of inflation, which this is the price that we pay. So we all agree that if you go out and fill your car up now, the price of gas is much, much higher than it was maybe a couple of years ago. That's inflation, the price of a gallon of milk. And we're going to talk about some of these things, but just know the reason the markets and everything are in this this up and down mode now. Every single day, it seems like we have big swings in the market because the market is trying to digest, and everyone, higher prices, whether it's a car, gas, used car, rent, you name it, everything is up significantly. When you compare the 50-year average to where it's at today, and again, if I had the most up-to-date slide of April, it was 8.3. it's basically almost double what the 50-year average has been for inflation. Keep in mind, one thing is that the Federal Reserve, they absolutely are very involved in how to set monetary pricing here. They want to make sure that they bring this inflation number down. So that's what's starting to spook the market. And we'll talk through this this evening, answer some questions that maybe several of you have. But what we want you to know is that the historical average versus today's prices is where they're trying to put this back in alignment. This could take another year. It could take 6 months. So again, every single month, you will see a CPI number. If we get anything less than 8%, that is a good thing. That means that inflation is starting to come down, but we may see this over the next several months because, again, we're feeling it right now, but the Federal Reserve is trying to slow things down. So I wanted to put this slide in because you can see if you go back to 1980s, even the 1970s on this chart, look at where this was, 12%. It actually was up at 15%. They want to make sure we're not going back to the 1970s. It's a time that we experienced what is called stagflation, right? Rates were going up, or I should say rates were already high, but inflation was high, but the economy was not growing. So keep that in mind as you hear and watch some of the economic data coming out. You may see that more and more. So very important slide. So I wanted to spend a few minutes on it. So investing 101, I mean, what are, we talked about this as it relates to inflation, but this is just showing you a chart. So you may be asking, okay, DJ, so tell me more about inflation. What does this really mean? Well, if I handed out to everyone on the call tonight, $200,000, yes, we all get 200,000. What does inflation mean? Well, here's what it means. If inflation was 3% today, that would actually be a good number, but it's actually 8%. But historically, 3 to 4% is where it's been. So what inflation means is $200,000 today over 40 years becomes 60,000. So 40 years from today, that number, just using a straight line inflation of 3%, that 200,000 now becomes 60,000. So that's what's important, is to make sure we understand what inflation is, how it potentially could be eroding your investing dollars, but also just the cost of living. And there's ways that we can overcome inflation. And that's why investing is very, very important tool to do that. So we'll go to the next slide, and then I'm going to turn this over to Carl. So one of the ways that we can actually, beat inflation is, of course, to invest. Now, we're not even going to talk about investing yet, but let's just talk about some rate of returns. So we would have to get maybe a 4, 5, or 6% rate of return to combat, of course, beating inflation. But this is just a quick chart, very easy to show here. It shows $5,000 that was invested every single year. And what does that do at a 6% rate over the next 30 years? So 5,000 becomes 395,000, assuming 5,000 was invested annually. We get a 6% growth rate. We're going to put all of our earnings back in, and we're going to do this over 30 years. So we're going to talk more specific about some of these investments and what they look like. But a great rule of thumb at the bottom of the page here before I turn it to Carl is the rule of 72, which we all have probably heard. So just take this 72, divide it by whatever your rate of return is. That's the number of years to double your funds. So clearly, if we're in an account that is paying 1%, it's going to take me 72 years. But just by doubling that rate or tripling that rate from there will shorten this period of time. So a very cool kind of rule of thumb here. So Carl, I'll turn it over to you for the next slides.
Sounds good. Thanks, DJ. Can you hear me okay? Yeah.
Yes, we can.
Okay. Hey, everybody. Before I jump in here, my name's Carl. I'm the financial advisor that covers the UCLA community as well as the Culver City branch. Thanks for having me. Hopefully you guys find the information on all these slides beneficial. And feel free to utilize the chat. I know I saw maybe a question or two come in, and we'll definitely address the questions as we go on. But the more questions, the more interactive it is. I think maybe the more that you'll get out of the presentation. So I'm going to jump in here, and DJ did a great job of kind of explaining one of the key aspects of why we invest, right? Aside from wanting to reach a certain goal or objective, or to reach financial comfort or independence, from a financial standpoint, we do it to at least keep up with inflation, right? With the cost of things going up on an annual basis or a monthly basis, right? And so when it comes to investing, the sooner folks start to do it, the better, right? And what I mean by that is generally over time, when you're investing over the years and compound interest starts to do its thing over time, you start to really see the benefits of investing, right? Of growing your money rather than letting it just sit in in a savings or a checking account for too long. And so really important to kind of get that, I guess, that idea in mind, especially when you're younger and you have your career, you have job, you have income coming in. Automating investing and doing it over a long period of time is an effective way to grow it, right? And this chart, pretty much this chart shows that, right? That somebody who's 20 years old and puts away about $250 per month and gets an average rate of return annually of about 6%. Over time, just doing that, over let's say a 40-year time period, you really start to see the benefits of it versus when you start later on. It's always a great thing to invest, right? It's never too late, but there's more money that needs to be invested in order to reach the same goal that the 20-year-old hit here, right? So yeah, keep that in mind. Investing, the earlier that you do it, the better. So now when we're talking about investing, like I mentioned, usually we're investing for some particular goal, right? Whether that's saving and investing towards maybe putting money away for the purchase of a home, right, or a property, or if it's putting money away towards retirement, right, or if it's wanting to buy a car in the next 5 years, right. There's different objectives that come into mind when we think about why we're investing, right. Ultimately, I think most folks look to have financial comfort, right, and financial freedom at some point while they're in their career and they're earning an income. But again, time horizon is going to be very important when we talk about investing, right? In general, the longer that your time horizon is, in other words, the longer the objective is from today, the more time you have to let your investments grow, and maybe that plays into your investment strategy. You can afford to maybe be more aggressive with investments when when the goal is way down the line, right? The investment objective or strategy changes whenever your goal is a shorter time frame. So we'll jump into this next slide here. Now, when we talk about investing, risk tolerance is very important, right? And the idea of risk tolerance is just the ability to absorb risk, or to absorb loss, I should say. And so there's different ways of thinking about that, right? We can have aggressive, risky investments that have maybe a lot of growth potential, but can also go through through heavy losses in a relatively short period of time. Cryptocurrency is a common investment type that might fit in that category, right? Maybe it has a lot of growth potential, but sometimes it could be very volatile. Or we can look at the other side of the spectrum that are more conservative investments that are lower risk, safer per se, but maybe they don't have as much growth potential as other investments, right? And again, risk tolerance and your personal time horizon kind of go hand in hand when picking the investments for to build your wealth over time. So here's a good chart to take a look at that pretty much illustrates the different investment types across different risk levels, right? And you'll notice that as you go up on this chart, the further right that you go, the riskier, let's say, or the more aggressive the investments are. But also the higher that you go, the more return potential that you have, right? So you'll notice at the very bottom, you'll have, things that like you can maybe get at a bank or at a credit union, right? CDs, right? As you move upward, you start getting into things like the stock market, right? Cryptocurrencies, things like that, where there's higher risk, but also more growth potential over time. And so if we start with kind of thinking about what, again, your personal time horizon, your risk tolerance, that's going to kind of come into play when you decide what investments you're going to be utilizing, right? At the very bottom, I'll touch on this, and I'm sure we'll touch on a little bit more later in the presentation, but most folks that I talk to, their initial experience with investing will be through a retirement account through their job, right? And so if any of you guys are currently working and then earning income from employment, you may have access to retirement accounts like 401ks or what are called 403bs through your job. And when you're putting money away into those retirement accounts, they're designed for way down the road, right? But what you're doing every time you get paid, you're actually investing on a bi-weekly basis if you get paid every 2 weeks, right? So oftentimes, without even knowing, most folks, their initial experience with investing comes in the form of a retirement account through their job, right? And so keep that in mind as we talk about that later on in the presentation. Now, if we're looking to to have money in a safe place with relatively low risk and have it be available and liquid and no penalties to take your money out, that's going to be things like cash alternatives, right? So imagine your savings accounts, money market accounts, right? Short-term government bonds. Those are going to be investment types or account types that are very, very low risk, safe, and a good place to put money away for an emergency or for money that you might need in the short term, right? But keep in mind, you'll notice it's on the lower end, on the left side of the chart. So there's not a lot of risk there, but there's also not a lot of interest or a lot of growth that you're going to get out of money there, right? Now, on the next slide, you'll see there's pros and cons with this, right? There's obviously, whenever you have anything in a savings account, a money market account at a bank or at a credit union, it's liquid, right? You can just walk in and take money out, right? There's no risk to your principal, right? Whatever you have in there is protected. But keep in mind, especially in times like now where inflation is really a hot topic. It's something that we're all feeling, right? When we go buy food or gas, or if you're flying anywhere, right? Airline tickets are really expensive right now. And so when we keep too much money in a money market or savings account earning less than 1%, you may not feel it right away, but over time, inflation starts to eat away at the value of that money. And so, keeping too much in something like this usually is not the way to go. But if it's short term, if there's a short term goal that you need to use the money for, or if it's just money you're keeping in this type of account for an emergency, that's usually what it's used for. So when we jump into this next slide, we'll look at what are called bonds, right? And an easy way to think about bonds is they're a debt instrument, right? So it's essentially it's like a loan that you're lending to a municipality, to an entity, or to like a corporation, right? It's an investment type where the entity that is issuing the bond essentially is borrowing money from you, let's say, and they promise to pay you back your money in a certain time period, let's say 3 years, for example. And while they, during that time frame, they promise to pay you interest, for borrowing those funds. And then at the end of the 3 years, your principal or your initial investment is returned. That's essentially how a bond works. And so they're still going to be considered relatively on the lower risk end of the spectrum. And the return potential will be higher than cash alternatives, but still considered low risk, relatively low return. Now, bonds can fluctuate, right? They're considered low risk, but they can fluctuate in value. We've actually seen that the last 5-6 months, that these low risk investments, even though they're considered that, because of interest rates rising, so quickly and so much relative to what they were doing the last 2 years, we've seen the value of bonds decrease, right? So again, it's an investment type that if you keep it until, let's call it maturity, right? Then the issuer, whoever you bought the bond from, they will pay your principal back, and they paid you interest, right? Considered low risk, but it can fluctuate in value. So a couple of pros and cons with, I guess this slide here real quick. There's a lot of different type of bonds that exist out there, right? There's the government, the U.S. government can issue bonds, or municipalities, right? The state of California, Los Angeles County, corporations, right? Your Facebooks, your Googles, companies can actually issue bonds as well as a way to raise money. But at the end of the day, it's essentially a debt instrument in which you let them borrow money. They promise to pay you back in a certain amount of time, and while they're borrowing the money, they're paying you interest for that time. And so with bonds, they're again, they're considered relatively low risk. They're predictable in the sense that exactly the type of interest or the coupon that you'll be making annually, and they're going to have a low correlation to the stock market. So oftentimes, whenever the stock market's not doing well, the bond market sometimes is a good. Bonds are sometimes a good investment to have to hedge against stock market risk. But sometimes that's not necessarily the case, and that's kind of what we're seeing now, where stocks and bonds are down. But again, when we jump into this next slide, we'll look at investment types that have more growth potential. This is just kind of showing you guys the performance of the bond market recently. You'll notice there's a lot of negatives on there, and so it's the bond market currently is not performing well. But historically speaking, if we look at decades of performance, generally the bond market will be more conservative in terms of the returns that we see versus stocks, right? And so if we jump to this next slide here, we'll see that stocks are, as we move up this chart that shows investments, stocks are going to be considered more aggressive than bonds, right? Stocks, they represent ownership in a company, right? And so they will fluctuate depending on the news that we hear from a particular company, right? How a company is performing, right? Their revenue, their profits, their balance sheets, right? And so stocks are generally going to be more volatile, right, than other investment types. You're going to see them swing often, and there's a lot of different type of stocks out there, right? Generally with stocks, not with all stocks, but for most of them, there's two ways that you make money. So one way is what's called capital appreciation. So that's just the price of your stock going up over time, right? And the second way is through dividends, right? If the company that you invest in issues dividends to shareholders on a periodic basis, that's the other way that you'll make money with stock ownership. And so if we go on here, you'll notice this is a chart, or not a chart, but pretty much a table that shows how the major indices that represent the stock market are doing, in the short term, right? So you'll notice this is through a couple days ago. Year to date, right? YTD there, the S&P 500, which generally is considered the index that represents the U.S. stock market, is down, almost 20%. 17.67. So it's definitely off to a not so good start, right? But again, oftentimes, like I tell members and clients, when we're investing, we're not going to be investing generally for the next 6 months or year, right? When you start to really focus in on building your nest egg over time, you're going to be investing on a periodic basis over the long term, right? Over the next 5, 10, 15, 20 years, right? And so on a table that shows the stock market over that time frame, you'll notice that the stock market does increase, but we all wish that the stock market would just be a straight line up. Unfortunately, it's not. It's a bumpy right up, but it does increase. So stocks will be there's a lot of different type of stocks. We won't spend too much time on this chart, but or on this slide, but there are stocks for small companies, large cap companies like like your Apples, your Microsofts, right? And there's generally a lot of different stocks that represent different sectors of the stock market, right? Growth stocks oftentimes will be companies that are in the tech sector, right? Blue chip stocks, for example, are going to be companies that have just been around for many decades and just have consistently shown positive profits and perform well, right? And so very important to kind of, if you're investing in individual stocks, to do your research and ensure that you're pretty familiar with the companies that you're investing in. And so in terms of pros and cons, right? With every investment type, there's those pros and cons. And so with stocks, historically speaking, they've performed well, right? Like I mentioned, the stocks are especially stocks from solid companies that shown great performance, they're going to do well over time, right? They will fluctuate, right? It could be volatile, but they will perform over time. But like I mentioned, there's a lot of market volatility currently, and so we're seeing that stocks, although they can do well over the years, in short time spurts, they can also decrease in value, right? So with that, DJ, I'll turn it back to you.
Okay, sounds good. All right, so let's get to the next slide here. Okay, so let's talk a little bit about some other investment options. As Carl did mention, of course, we went through some stocks, some bonds, different types. There is other vehicles to look at in the market, whether that's real estate, oil and gas, collectibles. Carl touched on Bitcoin, commodities, gold and silver. I mean, these are all additional types of investments out there. And what's interesting, if we went back 20, 30 years ago, you'd have to physically buy real estate. You have to physically buy commodities, where now they've packaged all of these. So you can invest, as little as $50 to $100 a month and actually invest in these type of vehicles. So you don't have to go out and buy a piece of property, but you can be shoulder to shoulder with other individuals that are actually investing in these types of vehicles. So how do you go about investing in these? Well, you can buy individual stocks, individual bonds, but I think probably the most popular way, whether it's in your retirement plan at work, which Carl touched on, the 401k plan, or this could potentially be, just outside your retirement plan. Maybe you're starting an investment account and you decide to open up a mutual fund. What's great about a mutual fund is this. There's a couple of bullet points on here. Is you're shoulder to shoulder with other investors, whether that's $50 a month or $500 a month or a lump sum that you're putting in. What they're going to do is pool your money with other investors. So let's say all of us tonight wanted to invest in a mutual fund. We each put $50 in. That money would get pulled together, and so that money would get distributed across many different stocks and bonds. Maybe that's Apple, maybe that's Procter and Gamble, different types of companies. But if we pull our money together, we can all, of course, focus on an investment strategy. Now, we may have some of us that are more aggressive and more conservative. So depending on that investment strategy, there's different mutual funds that are made specifically for what you're trying to accomplish. And here's the nice thing. You want a portion of securities. So you can instantly diversify. You may put $50 in, and it may be difficult to buy Apple stock because Apple stock's about $130, $140. But if you have $50 and that's pulled amongst other investors, all your money can be diversified across many different securities. And that's very, very important. So what's very important, though, about mutual funds, if you're ever considering a mutual fund, it's always important to do your homework. There's something what is called a prospectus. Now, a prospectus is something, whether it's a stock, a bond, a mutual fund, an ETF, it has to be provided to the general public. This prospectus is going to tell you everything. It's going to tell you about the cost, the objective, the risk, the charges, the expenses. So everyone can pull this prospectus. Now, I will tell you this, and Carl and I have been doing this for a while. Even looking at a prospectus for us can be very challenging. There's a lot of legal jargon in there. A lot of things are hidden, and it's a long, long document. But just know they do exist, and it's something that the public can pull to find out about the investment before they actually go through it. And that's one of the things what Carl and I do to help our members here at Wescom is when they sit down, we're the ones that go through and kind of, declutter all the different things that are out there and really can focus on helping someone interpret these prospectus and, what the risks are involved. Now, mutual funds, just like, the number of cars that are on the road, they come in all types and sizes. You can buy a mutual fund that just focuses on treasuries, and that would be what is called a money market fund. That's a mutual fund that keeps the money very short term and liquid. So maybe that's money that's going to be used to purchase a home. Then you may have that time in your life where you're thinking, you know what, I just need an income from my mutual fund. I want to live off the interest and that dividend and income that comes off that mutual fund. That may be a bond fund. Where every single month you're getting a check from that mutual fund. You also may be thinking, okay, I need to invest for the future. Maybe it's 5 or 10 years from now to save to purchase a home, start a business, or retire. And that may be a balanced or a stock fund. So again, every single type of mutual fund that exists out there, there's so many. Just know they all have different features, goals, and objectives. So it's really important to make sure that you know exactly aligning your goals with your mutual fund. In fact, how many mutual funds are out there today? There's about 8,000. I mean, that is just sometimes even overwhelming. But just know that mutual funds provide great diversification. There's professionals managing your money in these mutual funds. And the nice thing about mutual funds, you can start with $50 a month and you can keep adding to it. They're very liquid. So if you decide to use the funds, you can actually sell and get out of the mutual fund at the end of every trading day. The shares can fluctuate. They do go up and down just like stocks. But again, you know, a mutual fund can be very important for liquidity needs. If you're buying a home or buying a car, you can get at the money very efficiently. Now, there is some downsides to mutual funds. They do have expenses. And of course, there is some tax ramifications to be aware of. But mutual funds are a great way for the general public to start investing for the future. So I'm going to touch on this for a second. So everyone may have heard of what is called exchange traded funds, an ETF. So it's very similar and it looks and feels like a mutual fund. But again, there's 2,000 exchange traded funds today. Most of them are based on an index. So for an example, we showed some numbers earlier. The Dow Jones Industrials is 30 companies. The S&P 500 makes up 500 companies. So there's ETFs that are out there that are created to what we call mimic the index. They're going to replicate what the index is doing. Also, ETFs may have lower cost than mutual funds. The reason for that is some ETFs out there have what is called passive management. So really what you're doing is you're not having someone run the money for you, but basically what we're doing is we may mimic the S&P 500 index. So we don't have someone actively buying and selling. We're just going to mimic what the index is doing. And because of that, the costs are going to be much, much lower. A company that has done this tremendously well is Vanguard. They're probably one of the most well-known, ETF, mutual fund companies that are out there. And so they've done this, very, very well. And of course, ETFs can be traded like stocks. So for an example, a mutual fund, if you sat down with Carl and said, you know what, I need to take some money out of my mutual fund, what we do is it's called forward pricing. We actually would sell the mutual fund using the end of the day price. So we don't know the price until the market closes. Whereas an ETF, we can sell it immediately. So just know mutual funds and ETFs, this is kind of a chart that shows you how they're similar, but then also how they're different. Both are great vehicles for investing, but it also depends on what you're trying to accomplish. Give you a quick example. We have members that want to invest in the international market, investing in Europe and China and all the things that are happening over there. Now, it's a great way to invest, but it's also can be expensive. And so a lot of times when it comes to international investing, a lot of people use ETFs because it's a lower cost way to capture and participate in the international markets. So with that, Carl, I'm going to turn it over to you.
Thanks, DJ. Okay, so now in terms of a strategies of investing, right? Oftentimes you could, if you have a lump sum of money, right, you could just drop it in and buy an investment and just kind of let it ride over time. But a common strategy that a lot of folks use, especially this is most of us that have retirement accounts through our jobs, when we're adding money on a bi-weekly basis when we're getting paid, we're doing this. It's called dollar cost averaging, right? So the idea of dollar cost averaging is that on a regular kind of systematic basis, we're adding the same dollar amount and purchasing more shares of an investment, again, on a regular basis, right? And so the idea there is that we're buying shares of an investment at different prices, right? And so another thing is that we're spreading risk, right? Oftentimes when just imagine a situation where you have a lump sum and then you invest in some index fund that follows the stock market or the S&P 500 today, and then it decides to just tank for the next month or two, right? And so it could go the other way as well, right? But when we're dollar cost averaging, we're sort of spreading that risk, and we're buying shares of an investment over a certain period of time, and pretty much that allows you to get a lower average price on shares than you otherwise would, right? So something that if you're working or if you guys are going to be starting your careers here soon, it'll be something that you'll utilize oftentimes when you're investing in your retirement accounts at work. So we'll talk a little bit about asset allocation. If you want to go to the next slide again, DJ. So the idea of asset allocation is that we are investing in different types of investment vehicles, let's say, right? Things to consider is diversification, right? So investing in, let's say, mutual funds or exchange traded funds, ETFs, that have exposure to different parts of the stock market. As we're seeing recently, there's certain sectors of the stock market that are getting hit or decreasing in value more than other parts, right? And that'll be the same thing when the stock market's going up. There's different sectors that do better than others. So diversifying, again, kind of spreads your investment, kind of doesn't put your eggs in one basket, and allows for growth over time. Obviously, we talked about risk tolerance, right? That ties into your time horizon of whether you're going to need a certain account or a certain investment amount in the near term or way down the road. Personal financial situation, obviously, and your liquidity needs. And so we can jump to the next one, DJ. When we're looking at asset allocation, this is an example of what let's say a conservative investment account would look like, right? So half of the investment vehicles in the account would be allocated to bonds, right? If you guys remember, bonds are lower risk investments that have lower return potential. Cash alternatives, again, even lower risk, almost no risk type of investments with very, very low rate of returns. And then stocks, about 25% of an account would be stocks that have a lot of growth potential but can be volatile once in a while, right? This is more so a conservative allocation. If we go to something that looks more, let's say more moderate, right? Moderate would just pretty much tweak the percentages in stocks versus bonds, right? That's what you see here. So now we have more exposure to stocks, more growth potential, but also we take on a little bit higher level of risk and potentially more volatility in the short term whenever the stock market's not doing well. But long term, historically speaking, something like this would earn more than a conservative investment allocation. And then finally, we'll look at aggressive, right? When we're aggressive, we start to put the majority or most of what we have in a particular investment account exposed to the stock market, right? And so in this example, 75% of somebody's account would be invested in stocks, and then the rest kind of split between cash and bonds, right? This would be a good example of somebody who says, hey, I'm 30, 40 years away from retiring, and I'm not going to need this money for a long time, right? And this is a retirement account. Something like this, you could take as much exposure to the stock market as you like, because you're not going to need the money for a long time. You can afford to take on more risk to grow it more over time. So this is a good example of kind of different asset classes, right? Different sectors of the market, different investment types as well on here. The purpose of showing this chart is just to show that there's no one asset class that does the best every year or the worst, right? It'll depend, right? The market will be volatile. Different asset classes do better than others, and so when you diversify, right? That the whole idea of diversifying is that maybe you can invest in a certain sector of the market that does well this year, but you have exposure to another one that might do better next year, right? And so that's what this illustrates here in front of us. DJ, I'm going to turn it back to you.
Carl and DJ had a question that came in that's relevant to this as far as the diversification and the different options. So for mutual funds, if you want to invest in that, how does the distribution look as far as stocks, cash, alternatives versus bonds? How is that distributed out?
I'm guessing that question is asking how's the money within a mutual fund invested between stocks, bonds, and cash? Sounds like.
Yeah, I think so. I just didn't eloquate it very well.
No, that's good. That's good. It depends. The answer is it depends. It depends on whether a mutual fund is the objective of the mutual fund is to be more conservative, right? If that's going to be the case, then it's going to have much more exposure to bonds, right? There are mutual funds out there that are designed to provide income, right? A monthly dividend or a monthly income amount that it pays out. Those are going to be bond mutual funds that don't have any stocks in them. But then there's other mutual funds on the other end of the spectrum that are just 100% focused on stocks. And so those are going to be mutual funds that are considered aggressive, growth oriented. They're going to be very volatile whenever the stock market's volatile. But over time, they're also going to be the ones that earn the most, more so than a bond fund, for example, right? So it just depends. There's a wide spectrum on when it comes to mutual funds and ETFs on how much exposure they're going to have to stocks or bonds. It all depends on the fund's objective and whether they're trying to be more aggressive or more conservative. Hopefully that helps.
Thank you.
You got it.
Okay, so I know we have just under 10 minutes here, so maybe we go through a few more slides, and then David, if there's any other questions we should take, those are great questions, and it looks like I see maybe 10 or 12 in the chat box there, so if there's anything we can address, let us know. Just want to touch on a couple of final things here. So again, I know we talked a little bit about investing and some of the vehicles. We're going to just quickly touch on taxes. So as you're investing, of course, the market has done extremely well over the past several years. So now you're at that point where, let's say you're saving for that home or that car, maybe start a business. And of course, now you're thinking, okay, I'm going to actually cash out some of my earnings from my holdings and actually use the funds. So you can see here what is called capital gains. So these are taxes that would be owed on the earnings. Now, you can see here, if you're holding something greater than 1 year, tremendous benefit. So, I know there's a lot of talk about some of the wealthy individuals, billionaires that are out there, and why are they not paying taxes? Well, majority of these individuals are receiving stock from maybe companies they've started. And because they're receiving sometimes just stock, they haven't received any income or any salary from the organization that they started. You can see what the capital gains are. So look at someone who is single, and let's say they're making $500,000 a year or greater. As long as they're holding that investment for over a year, they're only going to pay 20%. So this has been always a big debate and discussion, but just know long-term capital gains are really the big focus of where you want to be. Anything holding longer than 1 year, you can see what the taxes are. So if you're making capital gains, but you're really, let's say, making $40,000 a year as far as your income, you're not going to pay any tax. If you hold it less than a year, it says ordinary income. What that means is wherever your income tax is based on your income, that's what you're going to pay on capital gains. So there's a big focus on making sure that you're holding your investment longer than 1 year. All right, let's just quickly touch on retirement accounts. And then maybe what we do is take some questions. I know we have a lot of slides here. Let me see if I can get to the slide that shows kind of a comparison of the different types of plans. And that may be, of course, the most important slide. And here it is. So this is kind of a summary slide that I wanted to put up here. And you may be looking at the slide. I know there's a lot of data. There's a lot of numbers on here. But what I want you to do is focus on the first column, the left-hand side column. Now, the first thing you're going to see is you're going to see these numbers at the top, 401k, 403b, 457. What are these? That's actually a code in the IRS that says these are company retirement plans. So maybe you just started at an outside job, or you're looking at starting that career, and you're going through the hiring process, and they tell you, you know what, we have a 401k here or 403b. These are just codes that the IRS uses to say that we have a company-sponsored retirement plan. But look at the middle column. That is actually how much money you can put into that plan. So as you start building your wealth and you're making great money at the organization that you just started at, or you're wanting to begin at, kind of lets you know how much you can actually put away. Now, if you look at the far right-hand column, what that is that saying that once you hit this magical age of 50, the government, the IRS says, you know what, because you're nearing retirement and maybe you don't have enough in your retirement nest egg, we're going to give you the opportunity to put more money away once you hit 50 years old. So there's this thing, it's called the 50 plus catch up. It just means that once you're over 50, they allow you to put a little bit more money away. Now, there's two areas I want to kind of close on to finish on. You're going to see on the left-hand side, traditional IRA, and then you're going to see below that, it says Roth, and that should be IRA. These are two accounts that you can actually open up without working for an organization, or let's say you work at an organization, but they don't have a retirement plan, as long as you have earned income from some sort of job. As long as you have earned income coming in, you can either open up a traditional IRA, or you can open up a Roth IRA, or you can do a combination of both, as long as you're not contributing more than $6,000 a year. So look at it this way. A traditional IRA is where money goes into this account. It could be into a mutual fund. It could be into some sort of stock. And again, you're going to be saving that money. It's going to be in that account until you retire. When you retire, you pull the money out of the IRA, and that's when you'll actually pay tax on that money. Now, what's interesting with a Roth IRA, and that's further down on the page here at the bottom, what's interesting about a Roth IRA, very, very important account for younger investors. In fact, I have a 18-year-old at home that just started his first job as he's going to college, and we're trying to get him to open this account up. Why is this so important? Because the money you put into a Roth IRA, what's important about it, you will pay tax before the money goes into this account. But here's the big thing about the Roth IRA. When the money comes out, it will come out tax-free. It will come out tax-free. So what's so important about the Roth IRA is if you open a Roth IRA up, you contribute to a Roth IRA, all of your earnings will be earned tax-deferred, but they'll come out tax-free. So how cool would that be in 10 to 20 years to say, you know what, I've accumulated enough money in my account here that has grown maybe 6 or 7 figures, and this account, of course, can be used tax-free when you retire. So again, wanted to kind of close on that note there, and we could probably spend another hour just going through different retirement plans, but I thought it would be important to cover that and go to that final slide there. And let me just put Carl's information up on the screen for everyone. Again, we are here as a resource for UCLA and the community. I oversee our team of advisors at Wescom, and Carl is one of our many great advisors. But the nice thing about Carl, he's dedicated to UCLA and is a UCLA alumni. So on that note, David, I'll turn it over to you and see if there's any final questions we can answer. I know it's 6 o'clock.
Yeah, there's 2 quick questions that I think we can get to. One is, I know on slide 29, you went over the differences between the mutual fund and the ETF. What's the main difference between an ETF and an index fund?
You want to take this, DJ?
Sure. Real quick. So let me just quickly go back to that slide too. So slide 29, that shows the difference there. What's interesting is you can have an ETF is kind of the vehicle, right? And so let's say we have an ETF, that's just the vehicle. But then inside of that, we basically want to invest in a basket or an index. So just like we mentioned earlier, there's so many different types of ETFs that are out there. There's over 2,000. But again, that ETF can have a focus on the index. So it could have specifically a mandate to mimic the index. It could have a mandate to say, I'm only going to take the top 10 from the index. So again, the ETF, as Carl says, there's so many different types, but you can find a specific ETF that is focused on an index like the Dow, the S&P, international indexes, a bond index. So again, a lot of different types out there, but an ETF is a great vehicle to invest.
Yeah, I'll add on to that, DJ. I'd say, Sophia, another difference is that an ETF is traded like a stock. It's kind of a technical difference, right? But because they're very similar, right? Oftentimes ETFs and index funds they're passive investments, and so they're, a particular basket of stocks are chosen, and it's not, there's no active trading or anything like that. They're chosen, and the company just lets it ride, right? But between an ETF and an index fund is almost like a subcategory of a mutual fund. But the index fund is passive in nature. There's no active trading of stocks within it. But an ETF can be traded, sold just like a stock, which means anytime throughout when the market's open. And then an index fund will trade at the end of every business day, just like a mutual fund.
Thank you.
You're welcome.
Lastly, the question that I promised the guys that I would get to is, I know there's different resources for stock investment. Someone wanted to know in particular what your thoughts are on Robinhood, and then we can close with that one.
Sure. I also see another one I'll touch on as well, if that's okay, David. Yeah, I mean, Robinhood is, there's a lot of online platforms that you guys can use for individual stock trading. I'm not going to really say we have a preference to which one, to use. But your Charles Schwab, Fidelity, Robinhood, those are going to be online platforms that they kind of sell themselves as no fees type platforms whenever you're trading stocks. Trading stocks oftentimes going to be kind of a DIY thing, right? Where you maybe do a little research on a company you like, and then you purchase stocks, shares. But yeah, Robinhood could be a good one. But again, there's a lot of them that are also good, right? The ones that have been around for a long time: Charles Schwab, Fidelity, TD Ameritrade, companies like that. Real quick, sorry, I saw another question here that says, is it better to use a Roth IRA or a Roth 401k? I'd say the answer is it depends, right? If you have access to a Roth 401k through your employer, the big benefit there, and I think Hudson, you mentioned it, is that the contribution amount is much higher, the limit that you can put in, right? They both work very similarly in the sense that the money that you put in is after tax money, right? And then it grows tax-free towards retirement. And so the Roth IRA is going to have a limit of $6,000 if you're under 50 and $7,000 if you're over 50 years old. The Roth 401k is obviously going to be much higher than that. But like mentioned in the question, Roth 401ks are still unique in the sense that not many employers offer them. But if your employer does offer them, it's something to highly consider, because it's another way to build your nest egg for down the road and create kind of a tax-free bucket towards retirement, in the future.
No, I appreciate that, Carl. DJ, thank you, and David, for great information, going through the chat and answering all the questions. Really appreciate that. Our winner for tonight's $20 UCLA Store gift card is Hudson. Hudson, you're the big winner. So Hudson, please get in touch with David Bochter. He'll be assisting you in rewarding the $20 UCLA Store gift card. So congratulations to Hudson. And on that, I just want to thank everyone associated with the Alumni Scholars Club and putting on this presentation, allowing us to present to you. And we really appreciate it. And we hope you enjoyed the rest of your evening. Thank you.